We're into Friday and the new year is just around the corner. Holiday trade has been anything but quiet and the thinner conditions have only made for wilder swings. And there's been good reason for volatility as the year comes to a close with so much uncertainty in the air heading into 2019. The U.S. equity market has, however, made a strong effort to shrug off a massive decline in the lead up to Christmas. But as we have been warning, we're into a different phase, a phase that is not as forgiving of downside risk, and one that is starting to show the emergence of a new kind of trend for risk markets where lower tops and lower lows are replacing what had been a near decade of buy the dip, higher highs and higher lows. All of the worry that had been there before the Wednesday rally is still right there into Friday. When looking at the bounce in the context of the pullback over the past several weeks, if we're to forget about levels for a moment, the rebound doesn't look all that impressive and shows the market still looking like it's rolling over off of record highs and very capable of continuing the declines. The most significant theme arguing for deeper setbacks in equities, and by extension risk assets, is the theme of the end to an unprecedented period of ultra-accommodative monetary policy. The fact that the Fed may not be looking to hike rates as much as it had been projecting, and the fact that the normalization process could be already nearing its end, should not be taken as bullish signs for risk assets. U.S. equities are only just now waking up to the effects of the end to the accommodation and the prospect that central banks and governments no longer have the ability to reverse back into that mode. We believe there is more of this that needs to be priced in, with the lag effect only now working through the system. And so, as awesome as the rally was on Wednesday, it is viewed as a corrective rally that will set up the next lower top ahead of another downside extension in U.S. equities. We believe things will become more heated on the political front in 2019, with the downturn in stocks making for an even more challenging backdrop for the U.S. administration, all while it pushes ahead with already risk-negative protectionist trade policy. Throw in the administration's battle with the Fed, and a Fed that will have to make some tough choices, and all of this strengthens this expectation for additional setbacks in stocks. And if things move in this direction, the Fed will be praying that inflation doesn't start to shoot up as well. That will only make things all the more complicated. On the currency side, a lot of what we're seeing is making sense. The risks we've talked about are US-centric, and we expect the market will be considering a different avenue for flight to safety bids, with the dollar all of a sudden a lot less attractive than it once was. This sets the stage for dollar underperformance against the major currencies, with the euro likely to absorb most of that redirected flow. The yen and franc will be sure to take some in as well, but as we've highlighted, the BOJ and SNB will be fighting against this flow as they have done so many times before. The pound will also benefit, but won't be able to take in too much until Brexit uncertainty is behind us. If Brexit is resolved in an orderly way, we actually think the pound will be in an even better position to outperform in 2019 than even the euro. Remember, all of the major currencies, the pound is the one that has been very strong on a longer-term basis and wouldn't be as resistant to an appreciation in the exchange rate. Looking at the levels, we think euro-dollar is the most important pair to watch. At the moment, euro rallies have been consistently met with resistance to keep the major pair in a range off of the 2018 low. But if we see the market push through the peak of that consolidation resistance, which comes in at 115, we believe it could trigger the start to a much bigger move that weakens the US dollar. Of course, inability to establish above 115 will keep the dollar in the driver's seat. That's all for now.